we going to do? Well, it actually didn't wind up being the RSPT. It wound up being something else called the MRRT. So somewhere along the line, something happened, and what was one tax got instead talked about as another tax. It's a bit confusing. What happened was the Gillard government. So the mining companies spent about $20 million on anti-Kevin Rudd campaign ads because of the resource super profits tax. So the mining companies were partially responsible for toppling Rudd and putting Gillard in place. And when Gillard got in place, she decided the mining companies had caused enough terror, and so she came to a deal with them. So she came to a deal with them. They decided that only, not all mining companies would be in it, so only a couple. Basically, just the big coal and iron ore ones would be in it, and that the base rate would be 30% tax rather than 40% tax. All that for $20 million. I've got to think that's probably one of the best campaign contributions anyone has ever done. For $20 million, you got rid of the guy who imposed a tax on you, and you got a 10% tax break, which at $65 billion, that's worth about $6 billion in saved taxes. So if you consider that for 20 million, they save 6 billion, that's a really good investment. I'm surprised more industries don't see that. We're kind of lucky. So yeah, so for $20 million, the mining companies got the whole scheme changed, and what actually got imposed was this MRRT. So we'll talk about that instead. Okay. So what do we know about taxes? Well, we already did taxes, right? We did taxes last week. What do taxes do? Well, when you stick a tax on something, so here we start at an equilibrium without taxes, so Q1 and P1, right? And then all of a sudden we stick a tax on things. And when you stick a tax on things, you put a gap between the price that the buyers see when they go buy something and the price that the sellers see when they sell something. So in this case, the sellers are the mining companies, and the buyers are, say, China. So in this case, we're putting a tax on coal that we're sending overseas. So the price of coal, Australian coal, goes up. The price that the mining companies get to see after they pay the taxes goes down. So what do the mining companies do? Well, they're making less money from coal because they're paying the tax now. So what do? Well, they sack some workers and they close down some coal plants because it's just not as profitable as it was before the tax. After all, the mining companies are paying some of the tax. So the mining companies reduce output, they reduce employment, and the Chinese customers see higher prices. Again, how do we see this in our market diagram? Well, in this case, producer and consumer surplus. So consumer surplus is a red area. That's kind of the benefits flowing to China. So the Chinese are worse off. Why? Well, price goes up. Quantity of coal goes down. Consumers have to be worse off. What about the Australian mining companies? Well, their producer surplus falls as well. They sell less coal at a lower price than before the tax. So mining companies have to be worse off. Who's better off? Who gets the gap in the middle, the wedge, the green area? Well, that's the taxpayers. So the taxpayers now get to keep the tax, right, times the quantity sold. So that's the tax revenues. So you can see that a tax on something like coal will raise tax revenues for the government. It will certainly do that. And the Australian taxpayers then get a larger share. But the problem is it does this at a cost. And the cost is that output is lower, so mining company employment will be lower. Fewer miners will be employed. And they'll be employed at lower wages because mining company profits after tax are lower as well. Mining companies produce less, employ fewer people at lower wages than before. The taxpayer gets something, but we have a loss in social value. And the loss in social value is kind of that white-shaped area. That's really the net value of the coal we don't dig up. We leave that coal in the ground because it's not profitable for the mining companies to dig up that coal. Instead, we only dig up Q tax rather than Q1 after tax is put in place. So taxes reduce social value is another way of thinking about it. So this is what the Henry Review was talking about is, well, we'd like taxpayers to get a larger share, but we don't want to have this. We don't want, in a sense, to stop companies mining. we want companies to keep mining, but we don't. But we also would like to have a larger share of the benefits of mining flowing to taxpayers. So that, Australians, we don't mind mining. We just want to make sure that the Australian taxpayers get to keep more of the benefits of mining. After all those miners are Australian as well. So how can we raise mining taxes without reducing output is kind of the puzzle.